Hi YouTube, how are you? Today's topic that I want to cover are selling puts. It's a topic that we all should know about, especially if you're looking to make income in the stock market. And by income, I mean that we're going to be putting some collateral down, but we are putting the collateral down saying if the stock that we like, right, that we would buy anyway, but we are placing our price that we are willing to buy 100 shares at a particular strike price, which is great. And in addition, because this is the bonus part of it, you'll give me a credit for it if at the end of the time that we set, it doesn't go below that level. They'll give us the credit. Even if it goes below that level, they'll still give us the credit. So it's a win-win on that situation. So I want to go over two stocks as an example for you because one is a little bit more expensive, not super expensive, but a little bit more. And I know it's 100 shares that you need to buy. You're committing to 100 shares, so it's a little bit more money. And then I'm going to show you one. I'm going to talk about Robinhood, and then the other one is going to be SoFi. All right, so let's go and show you how I would go about this. All right, so here we are. Let's look at SoFi. We could do regular charting, but I'm going to make this a little bit easier just so we can look at levels. I'm going to put other videos up on how to chart more in depth, but just as this is just an overview of selling puts. So I did the fibs. I put it from low to high, okay? So again, going back to this example where I would say I don't mind owning 100 shares of SoFi if, let's look now, if it comes down to about 1620, right? Because it's spent time there already. It's a possibility if it does drop, it's going to bounce off of that level. So that's a level that I'd be interested in. This is another one, 1454. Again, it spent time here, right? It rejected, it bounced, it bounced, it bounced, it bounced, right? So these are levels that I would find, this rejected, but this would be a level that I would say, I wouldn't mind owning it because there was a big response here as far as holding this level. The next one would be down here, which would be this, let's see, 1348, because this would be 50% from where we are now that it would drop. Again, it spent time here. There was a reaction. We're looking for reactions. We don't want a place that it did not have any reaction because if it drops to that level, it's not going to have a reaction. We want a level that it's going to bounce off of. Now, this level, the 50%, and I'm pretty sure this 1450 is not going to pay us as much, but let's look. So there's something else I need to explain. Something I look at when I'm placing this type of position is I'm going to be looking at the delta. There's a couple definitions of delta, but two that are important to know are the delta when you're buying something, right? So when you're buying something, the delta will tell you the probability that it'll move. So let's say I'm going to look here at this 19. I'm going to round up and make it easier so it's 20, right? So at this 17 level, if I were to buy a put, there is a 20% chance that this is going to go our way. If I'm taking the other side of the position, it's 80%, right? Because delta needs to equal 1 because there's always a buyer and a seller. The buyer of this put would hold on to the 20% and the seller is 80%. That would equal 100, right? So the selling of that put has a higher probability that it's not going to come down to 17, right? There's a higher probability that it won't come down there. So let's take a look again at the chart. 17 is actually higher than our 1621. So we're going to be around here, okay? Which actually is not bad because it does line up with this where there was a reaction previous. So let's just look at this. We're going to look at the 4-hour. It doesn't extend that far, but now just to look here, we're going to make a line here just so we know where the 17 level is, so we can see it on a smaller time frame. So we're going to do this. I'm going to give it 4 more cents, but you can see that. You can see it here, right? You can see that this would be 17. Again, we had a reaction there. There was a little reaction here. There was another reaction here. So off of these two levels, there was a reaction that it's possible that if it happens to come down, it's going to bounce off of that level. Again, here's our 17. You can even see here how it was a reaction because it tried to get through, it almost rejected, and then it came above, it came down to test that level, and then took off. So the fact that it had a reaction here, even on the 30-minute, I like that. So let's come back here and say, all right, how much are you willing to pay for that position? If I were to put $1,700 down, they would pay me about 23 cents, because I'm more or less in the middle of this. They would pay me 23 cents for this position. Okay, you may not think that that's a lot, but that's something. Think about how much money you could make in 2 weeks if you were to put $1,700 down in a money market. Probably not much, right? So to me, that's not bad. I would take that position, because if it does come down to 17, I'll be happy about it because it's a position I'm getting a discount on. Let's look now at the third week out of August. So now the delta is somewhere between 16 and 15. Again, I'll take that 16 because if we come back here and look, 16 was a good level. Let's look at the 1 hour. 16 was a good level. Let's see, 4 hour. 16, again, all that reaction that we had here. I'll take that bet. So we're going, again, I'm going to round up 2, so it's still 80%. Technically, it'd be a little bit less, 78%, but I'll take those odds. If I were to put my money down, the 1,600 this time, they will give me about $59, $60 for this position, right? So what happens if it does drop below the $16? Then I'm going to own the shares at 16 minus the credit. So the basis is going to be a little bit lower than the $16. But I'll be in a position, a stock that I wouldn't mind owning, okay? So now let's look at Hood. This one I've been doing for a little bit, and I'm not upset, I'll tell you that. I'm actually quite happy with Hood and the way that it's been moving, because I've just been rolling it. So let's see, 186, 88, is it? Okay. Here we are in this position. If it came down to 80, we have a reaction. We have a reaction here at 67. So let's come over here and let's look at July 18th. We're going to put in Hood. Here we are. Okay, let's look for a delta of 20, because that, again, it's up to you, really. If you think that 80% the probability is still, you don't want to put that much risk, you can always lower it, right? You can always say, I wouldn't mind making it into 90% that it's going to go my way. Okay, then you're going to get a little bit less, but that's great. That's absolutely fine. If you're more of a risk taker and you really like this stock and you don't care if it comes down, then go about it. You adjust your risk accordingly. I'm sticking still around this 20. So what I've been doing is I've been selling the put at 80, right? I've been doing this since April, and I've been getting about 75%, 80 of my price, and I roll it to the next month, and I roll it, and I roll it, and I roll it. So in this particular case, 80, I'm already up on this one because it was at 20%, and now it's I'm already up 50%. If I were to enter this position now, you can make around 165 for this 85 if you wanted to do that, which equals that 20 delta. So if by July 18th, Hood does not come down to 85, you'll be able to make $165 off of this $8,500 that you're going to put down as collateral. So remember, when it comes to options, you're obligating yourself to buy 100 shares. So that's why it's so much. It's not you saying, I just want to buy one. You're obligating, because it's a contract. You can't split the contracts. You're obligated now to buy 100. So that's not bad. We'll see as this is why I've been able to get out quicker. Because let's just look at the 30. See how this Where's 80? 80 is right here. 80, as we start moving up above and away from 80, the 20% becomes of the delta will become smaller and smaller and smaller, meaning that if you want to get out of this position, we are able to get out of this position, maybe not 100%, but like I did, I took 75% of the money off, quick, within a week, quick, because the stock is just continually going up. So if you, instead of buying calls on something and you want to sell puts, this is a safer way of you utilizing your money. It's a much safer way because if you're wrong, you'll end up with a consolation prize, which are shares of a company that you like anyway. What you can then do is, as the stock goes up, or is if it just sits there, you can now sell a call against that position. But I'm going to make another video and explain that. But you could sell a call on this position and then get out. The way that would work is, let's say we happen to come down to 85 here. Now you own this at 85. It's going to be a little less, probably, I don't know, 84, 83 is going to be your basis. Let's say now you're saying, I'm going to sell this call for August. As long as you sell it above that 85, because that way you collect and keep the credit that you received, you'll be able to cash in even more, because this is 1,500 now. Let's say we were under that and you wanted to be more aggressive. Anything above 85, maybe you want to sell it at the 90 or maybe the 100, right? Because this is still 47, we'll round up. That's 50%. At 50-50, we don't know what's going to happen. But you know that you can make about $770 if by August 15th, hood does not go above 100. If it goes above 100, you lose the shares in that particular case. But not bad if you got assigned company stocks in a company that you like. So this is why I like doing this this strategy, because it really makes me easy money. I don't have to do anything. I just come back and I look at the charts and I say, all right, this is a good level. As time goes by, because this is something that is very important to look at, is your theta. Theta, usually when you are buying a call or buying a put, it's like a ticking timer. This theta is eating up your position here every day, right? It's like it's tick, 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 tick. It's constantly going, and it's taking a part of this value that we have here. It's taking it away when you're buying something. But when you're selling something, this is positive, because you eventually want this to go to zero. Because if this goes to zero, that means that money is now in your pocket, right? So that's what you want, ideally. Because again, if we go back and look at the one that I did in July 18th, right, the 80 that I sold, at one point, and if you look back to, where is my delta of 20? Here we go. At one point, this was about $1.55, right? You can see that. Now, because that's the 20, yeah, now it's 50% because it's at 10%. So now, do you see how the ask and the bid are going lower and lower and lower, right? Because the value of that is being eaten up by theta and by the stock going up. So two ways you can make money in this quicker is if the stock starts going up, right? You can cash out quicker. But regardless, as long as this doesn't go below your strike, 80, 85, whatever it is, as long as it stays above it, it keeps eating away at the value of this, of the value of what it was worth, right? Again, so that's 85. Where's my 20 here? 90, and now it's going down lower. So that's what we want. So that's why this is great, because about 80%, if not more, of options that people buy end up being worthless. So why not be on that side of the trade? I mean, that sounds like a win-win to me, all right? You want to be on the winning side of a trade. So this is a great strategy to use. If you have the collateral to use this, amazing, right? I mentioned it the other day to somebody. I said, hey, if you have an extra $2,700, and he was like, no, I don't, but I can see why you do what you do, because this is just easy money, right? It's just easy money. The market is going up, so we look for stocks that we don't mind owning again. And I'll keep saying it over and over again, because don't come to me and say, I bought a penny stock and I sold puts on something and now I own this stock that I don't want anymore. No, it has to be stocks that you want to own and you don't care, and things that you would want to put in your portfolio anyway. All right, so let me know if you have any questions. I will clarify if you need me to explain it further, but I'm going to do another video now on selling puts to sell calls to accompany this video on selling puts. All right, have a great night. Bye-bye.